The reason Ripple XRP was created in 2012. Ripple, then known as OpenCoin, was quietly launched in California in the summer of 2012, just a few weeks after the LIBOR scandal erupted. To understand why Ripple XRP came into existence, we need to look at information from the Mutual Non-Disclosure and Strategic Cooperation Agreement (NDA). But before that, you must first understand the collapse of LIBOR in June 2012. That collapse is the key reason the world needed a consensus ledger with real-time settlement of payments. The collapse of LIBOR. 1. June 2012, Barclays admits false reporting of LIBOR rates. Barclays became the first bank exposed in the scandal when it admitted to deliberately manipulating its LIBOR submissions to benefit its own trading positions or to mask its financial weakness during the 2008 crisis. Fines and direct impact. Barclays was fined a total of about £290 million for $150 million United States dollars by regulators, including the UK's Financial Conduct Authority (FCA) £59.5 million. The U.S. Commodity Futures Trading Commission (FTC) USD 200 meters, and the U.S. Department of Justice USD 160 meters. This record penalty at the time led to the resignation of CEO Bob Diamond and other senior executives. The fine itself was only the tip of the iceberg. It reflected Barclays' early cooperation with regulators, which allowed the bank to avoid harsher criminal charges. Systemic damage. LIBOR was the backbone of the financial system, underpinning over 350 trillion United States dollars worth of global contracts, derivatives, loans, mortgages, and bonds. Manipulation distorted borrowing costs, impacting consumers, for example, higher mortgage rates. Businesses and governments. The scandal revealed a critical flaw. LIBOR relied on self-reported submissions without strong oversight, making it vulnerable to manipulation. This triggered a global loss of trust and reform efforts to replace subjective reporting with benchmarks based on actual transactions. 2. Not just Barclays. The involvement of 16 global banks. The scandal extended far beyond Barclays. Investigations across the UK, US, EU, and beyond uncovered that at least 16 major global banks, including Deutsche Bank, RBS, Societe Generale, Citigroup, Morgan Chase, UBS, and others, were involved in manipulating submissions. Scope and motive. Traders and submitters coordinated via emails, chats, and phone calls to move LIBOR rates in their favor, either to profit from derivative positions or to make financial statements appear stronger during the crisis. Between 2005 and 2009, some banks deliberately underreported rates to hide credit risk. Systemic failure. LIBOR was overseen by the British Bankers Association (BBA), but without independent oversight. The system enabled collective misconduct. Broader impact. Because LIBOR was public, many financial institutions either knew or suspected manipulation as early as 2008, as reported by the Wall Street Journal. Yet, a collective silence prevailed, reflecting the too-big-to-fail culture where profit came before ethics. The scandal led to massive lawsuits from investors and governments, with damages estimated in the billions. Global penalties. Total fines eventually exceeded 9 billion United States dollars, with Deutsche Bank receiving the largest penalty to 2.5 billion United States dollars in 2015. 3. Why Barclays became the scapegoat. Barclays was not the only offender, but it became the first to be exposed due to strategic and political timing. Early cooperation. Barclays had begun cooperating with UK and US regulators as early as 2010, handing over internal evidence, emails, and recordings in exchange for leniency. This made it the first to be punished publicly, while other banks like RBS and UBS were penalized later 2013 to 2015 as investigations widened. Regulators showcased Barclays as an example of decisive action, while other banks had more time to prepare and negotiate. Media and political pressure. The scandal broke amid public anger after the 2008 crisis. UK and US media heavily targeted Barclays, sparking parliamentary hearings and executive resignations. Other banks ultimately faced larger fines, but escaped similar levels of public outrage because Barclays had already absorbed the initial shock. Systemic lesson: Barclays' sacrifice accelerated global reforms. In 2014, LIBOR oversight shifted to ICE benchmark administration, and by 2023, LIBOR was fully phased out. The case highlighted the need for transparency in finance, but also exposed a troubling pattern. Major scandals usually end with corporate fines, while only a few individual employees face jail time. The NDA connection and why Ripple was born. The Mutual Non-Disclosure and Strategic Cooperation Agreement governed the exchange of sensitive, non-public information necessary to assess models of joint operations and explore the possibility of building multi-layered liquidity corridors worldwide via the XRP within regulated financial environments. In other words, the collapse of trust in LIBOR, the very benchmark that underpinned global finance, showed the urgent need for a new consensus-based ledger capable of enabling real-time, trust-minimized settlement. The turning point: 2012. The downfall of LIBOR was not just about one scandal in 2012, but the peak of decades-long structural flaws in financial benchmarks. It reshaped how global interest rates are managed, driving regulators to adopt transaction-based systems, for example, SOFR in the US. And it was in that same summer of 2012, just weeks after the LIBOR scandal broke, that Ripple, then OpenCoin, quietly launched in California.